ETFs or exchange traded funds can be an ideal investment vehicle for investors looking to earn consistent returns in a cost effective manner. I'm that finance girl, and in today's video, we'll discuss all you need to know about ETFs. By the end of this video, you'll have learned the following: what is an ETF? What makes ETF investing an attractive option? Owning an ETF or an individual stock, which is better? Stocks versus ETFs versus mutual funds? The difference between active and passive management? And towards the end, we'll quickly review today's lesson. So now, without further ado, let's get started. What is an ETF? The abbreviation ETF stands for Exchange Traded Fund. Let's look at the individual components that make up the term. The word trading means buying and selling. An exchange is a marketplace where financial instruments are bought and sold or traded. You may have heard of stock exchanges like the New York Stock Exchange or the Bombay Stock Exchange. From our discussion so far, we can infer that an ETF is a fund that is traded on exchanges. Now, what do you understand by the word fund? Think of a fund as a basket of securities. This basket can hold securities such as stocks or bonds or commodities. Let's take the example of stocks. A stock ETF is essentially a basket of stocks, and this basket trades on a stock exchange. Now let's discuss ETF investing in greater detail to understand what makes it an attractive option, especially for beginner investors. A majority of ETFs track a benchmark index. So what is an index? A benchmark index is an indicator of the overall performance of the stock market. Let's take the example of the Indian stock market to understand the concept better. In India, the Nifty is a benchmark index that indicates the overall performance of the National Stock Exchange. Now, what does this mean? There are nearly 2,000 companies listed on the National Stock Exchange. It would be next to impossible to track the performance of all of these companies to arrive at a conclusion about the market's overall performance. Therefore, out of the 2,000 listed companies, 50 of the most important ones are chosen to represent the performance of the entire market. If most of these 50 companies show an increase in prices, we say that the markets are going up. If most of the companies show a decrease in prices, we say that the markets are going down. And if the trend is not clear, we say that the markets are moving sideways. Thus, the Nifty index is essentially a collection of 50 companies that represent the performance of the broader markets. As I mentioned earlier, most ETFs track a benchmark index. This means that they aim to replicate or mimic the returns achieved by the index they are tracking. So if an ETF was tracking the Nifty index, it would aim to mimic the returns achieved by the Nifty. As the markets tend to generate positive returns in the long run, an ETF mimicking a market index will also most likely generate positive returns if you buy and hold it for a sufficiently long period of time. This is what makes ETF investing a safe and attractive option, especially for beginner investors with limited expertise and knowledge about the markets. Those looking to generate consistent returns at a low cost can benefit immensely from investing in ETFs. Now we'll take a look at the next topic on the list. Let's take an example to understand whether you should choose an ETF over a stock or the other way around. Let's say there's an ETF called XYZ ETF that tracks the Nifty index. And let's assume that one share of the Infosys stock and one share of XYZ ETF are both trading at 1000 rupees. If you had to choose between the two, let's see which one would be more beneficial. As discussed earlier, a stock ETF is a basket of stocks. And since XYZ ETF tracks Nifty, it's essentially a basket containing the 50 Nifty stocks. Incidentally, Infosys is one of the stocks in the basket among many others such as Reliance, HDFC Bank, ICICI Bank, TCS, ITC, etc. Now, instead of buying one share of Infosys, if you were to buy one share of XYZ ETF, you would get exposure to all the 50 stocks that XYZ ETF holds at no extra cost. Thus, choosing the ETF would help you diversify your portfolio and minimize risk. This means that on a particular day, if the price of Infosys was to fall drastically for some reason, you would have suffered a major loss had you been holding one share of Infosys. However, if the prices of Reliance, HDFC Bank, ICICI Bank, TCS, and ITC were to increase on that day in spite of the fact that Infosys dropped sharply, the price of the ETF would go up. Thus, by providing diversification, ETFs help mitigate the risk you would be exposed to had you invested all your money in a single stock. Please note that although individual stocks come with more risk, they can produce higher potential returns. ETFs, on the other hand, are low risk investments that generate stable returns, especially if you buy and hold them for long periods of time. Whatever your preferred investment vehicle may be, you must conduct thorough research and make investment decisions that best suit your specific needs. Now let's go on to the next topic. An ETF is essentially a cross between a mutual fund and a stock. Just like individual stocks, ETFs are listed on an exchange and their prices fluctuate throughout the trading day as they are bought and sold. Like ETFs, a mutual fund too is a basket of securities. However, mutual funds do not trade on exchanges. They trade only once a day after the market closes. ETFs combine the best attributes of both stocks and mutual funds. Like mutual funds, ETFs give you exposure to multiple securities at once, allowing you to instantly diversify your portfolio. And since ETFs trade on the open market like individual stocks, they are often considered more liquid than mutual funds. That is, they can be converted into cash more easily than mutual funds. Besides, ETFs generally have lower expense ratios or annual fees than mutual funds, as they are typically passively managed funds. Now let's understand the difference between active and passive management. Most ETFs are passively managed investments as opposed to mutual funds, which are typically actively managed. The goal of actively managed funds is to beat the market, whereas passively managed funds aim to match the market's performance rather than outperform it. With actively managed funds, the fund manager handpicks the stocks to include in your portfolio, hoping to generate returns better than the market. Passively managed funds, on the other hand, do not require active participation. Numerous studies and statistics have shown that over long periods, passively managed funds such as ETFs tend to outperform actively managed funds, and for many investors may very well be the way to go. Whether passive investing makes more money or active investing is an ongoing debate that's unlikely to be resolved anytime soon. Individual investors should choose the option that best aligns with their particular investment objectives and risk tolerance. Now let's quickly review all that we've learned today. An ETF, or an exchange-traded fund, is a fund that trades on exchanges. Most ETFs track a benchmark index, that is, they aim to replicate or mimic the returns achieved by the index they are tracking. ETFs combine the best attributes of both stocks and mutual funds. Like mutual funds, ETFs provide exposure to multiple securities at once, allowing you to instantly diversify your portfolio. And since ETFs trade on exchanges like individual stocks, they are often considered more liquid than mutual funds. Research shows that over long periods of time, passively managed funds like ETFs tend to outperform actively managed funds such as mutual funds. Those looking to generate consistent returns at a low cost can benefit immensely from investing in ETFs. Conducting ETF due diligence before investing is essential and should never be overlooked. I hope this video helped you understand all about ETFs. If you enjoyed today's video, please make sure to subscribe to my channel. Also hit the bell icon to never miss another update. Please hit the like button and share this video with someone who could benefit from it. If you have any questions or suggestions for me, you can leave them in the comments below and I'll be sure to get back to you as soon as I can. Thank you for sticking around till the end. Take care and I'll see you in the next one.